Welcome, everyone. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and this is Trading Places Live. It's Tuesday, May 2nd, 2023, and I'm pre-recording this Trading Places Live for just a little bit later this morning. Let's see. Currently, we have futures that are pointing just a little bit lower. We got Dow futures down about 70, S&P 500 futures down 7, NASDAQ down about 7 as well. Crude oil down about 20 cents, still sitting around that 75.50 per barrel area. And the U.S. 10-year Treasury yield at 3.54%. That's down close to 4 percentage points, 4 basis points. So we've got the Fed meeting coming up. That starts today. We'll have the latest Fed policy statement out tomorrow at 2 o'clock Eastern, 2 p.m. Eastern. So at least beware of that. We got jobs reports coming up this week, ADP employment on Wednesday, non-farm payrolls on Friday. So market's got a lot to trade off of this week for sure. And we got a lot to talk about today. So let's go ahead and jump into that agenda. Daily market recap, that's where we'll start. And talking technically. Chart of the day, take a look at a semiconductor stock. Sector strength, chart breakouts, earnings spotlight, and the 3 you must see. So we got a lot going on there. And we're going to start it off here with the daily market recap. So let's jump right in. Dow Jones Industrial Average on Monday fell 46 points. S&P 500 was down 1. NASDAQ was down about 14. Mid caps down 0.29. Small caps down 1 point. So literally everything was down, but fractionally, very barely down. The most significant thing, I think, among those 5 indices is that the S&P 500, if you go back to the beginning of February, the closing high was 41.79, and yesterday we were above that intraday on the S&P 500, but we failed to close there. So we had a false breakout. Volume was light, so it didn't look to me like there was a lot of shares unloaded. So I'm not too worried. Plus, we do have breakouts on some of the other indices. But with all that's going on this week between the Fed and these job reports, I think this is going to be a critical week for the S&P 500. I think with all that news coming out, if we can't make that breakout and we just churn, I do think short term we could begin to see a little bit of wear and tear on the market. Perhaps we pull back. But I do think this is a catalyst, potential catalyst for a breakout. Given this news, if the Fed turns, everyone's widely expecting a 25 basis point hike. I'm assuming that's what they'll do. But I got to tell you, when you look at the Fed, everybody's blaming the bank fallout on poor management, poor risk management, and so forth. But you got to at least say the Fed is partly to blame. They continue raising rates. I mean, this is, I don't know how many now we've had. We have we've slowed the amount of these hikes going from 50 basis points down to 25, but they continue to raise rates in the face of a potential banking crisis. I probably shouldn't even say potential. We've seen some banks already go under and into FDIC receivership. So part of what's going on here is that it's much more expensive for banks to borrow from one another in the short term. That's what the Fed funds rate is all about. And so as the Fed keeps raising rates, they're making business more expensive for banks. So you got to at least say, hey, they're contributing somewhat to what's going on. And let's not forget, the Federal Reserve isn't just about raising rates or lowering rates. They are the oversight organization for all the banks. They do Federal Reserve audits. They go out, they see these banks, they evaluate management, they're looking at the numbers. These banks shouldn't just be showing up and failing. So again, I think you've got to at least put a little bit of the blame at the Fed's doorstep. Their job is to oversee these banks. They should see some of this coming, you would think. Anyway, not real happy with this Fed for a number of reasons, but that's one of them. The problem I have with the rate hikes is that you've got the bond market, the long end of the yield curve. You look at something like the 10-year Treasury yield, which has been, I mean, that topped back in October of last year and has come down. It's probably down 80 basis points from where it was. So when you look at the inverted yield curve, there's a couple of reasons for it, and a big one is the Fed. The Fed keeps raising the low end, the shorter end of the yield curve continues to get raised. The Fed continues to raise Fed funds rates or Fed funds rate. And at the same time, the bond market's telling us, what inflation? What are you doing? Why do you keep raising rates? We know the economy is showing signs of weakness. Got a lot of folks predicting recession. Why do you keep raising rates? Oh, that's right. You want to get ahead of the inflation curve. Well, the bond market says you've already done it. So I don't know. This is just my opinion. You can disagree. Everyone has their own opinion. But I feel like the Fed's gone overboard. They went forever. They took too long to react to it. And hey, I'm not saying that was the wrong move. I didn't think that they should have acted earlier than they did in terms of raising rates. So I was right on board with them. I thought that, the inflation problem was going to be transitory. That was the word the Fed used. I thought it was going to be short term as well. I was wrong. They were wrong. They started raising rates, and I just think they've gone too far. But that's me. Anyway, major indices, as you can see, just kind of going sideways yesterday, not really doing anything to open the month of May. This is when we do see a lot of money inflows, though. It's not unusual to see the market move higher during the first week of calendar months because that's when a lot of money is coming in to the market. That's what sends prices higher historically. But first day of May, not so much. We'll see what happens the rest of the week. As far as the sectors go, industrials and healthcare were your two big leaders, both rising a little bit more than 0.5%. Energy down 1%, a little over 1%. Discretionary down about 1%. Real estate down about 0.9%. So really a mixture in terms of some doing well, some not doing so well. You had an aggressive group, industrials leading. You had an aggressive group, discretionary, that was lagging. You had a defensive group that was leading in healthcare. You had a defensive group lagging in real estate. I mean, it was all over the place. Really not a whole lot to take from yesterday's action. And again, as I mentioned, if you look across here, volume was pretty light across the board. So we'll see what happens the rest of the week. All eyes will be on the Fed, certainly for the next couple of days, at least tomorrow at 2 p.m. when that policy decision comes out. I think they'll raise by 25 basis points just because that's what they've been pointing toward. But what do they say? Do they acknowledge that we're starting to see weakness in the economy? Do they acknowledge that they're winning the fight against inflation? Because they started that a month ago, saying that, hey, we're feeling pretty good. We got things headed in the right direction. We're seeing signs. Is that the same talk this month? Or do they potentially say, hey, we are not really, we're going to be data dependent, but we're not really seeing more rate hikes ahead? Are they going to come up with some kind of language that leads the market to believe that maybe this is the last one? Anyway, some of those things, we need to be thinking about it as we go forward. 10-year Treasury yield. So March factory orders will be out this morning. That's expected to jump considerably. Last month, February, well, I shouldn't say last month because these are old. We're now into May. But the February factory orders fell 0.7%. March expected to jump by 1.3%. And as I mentioned, the FOMC meeting begins today. 10-year Treasury yield yesterday, you can see jumped up about 12 basis points. Still all within this range, short term. I'm going to say right around that 320. Well, I've been saying 329, 330. I guess we could go down to about 327. Upside around 365. I mean, that's the range where the 10-year Treasury yield has been living. So the big move up yesterday, well, yeah, it was 12 basis points. That's a pretty good bump, but it's all within this range still. Moving on, let's talk technically here for a minute. S&P 500 there was that breakout intraday. So we had 41.79 on our radar. We talked about it over Trading Places Live, our show over at Earnings Beats yesterday. 41.79 was the number. Yesterday we got up to 41.86, almost 41.87. So intraday we were making the breakout, although we didn't take out the intraday high from beginning of February. That number was at 41.95. So for those of you who are more interested in intraday highs, 41.95 needs to be cleared. I'm more of a candle body type of a technical analyst. So I like to see opens and closes. That, to me, especially with stocks, that's where you've got market makers signing off at the end of the day, signing off at the beginning of the day. I mean, when we get these gap ups, gap downs, a lot of times it's market makers that drive that based on news, based on perceptions, based on expected events, based on whatever you want to call it. But market makers tend to open higher or lower from the prior day's close. And then at the end of the day, what are they doing at the end of the day? Are they buying for themselves? Are they buying for institutional clients? Are they finishing on the high? Are they finishing somewhere in between? Big sell-off in the afternoon? Are they finishing lower? All those things matter. That's why I follow candle bodies. NASDAQ 100, not really much difference, down a little bit. We did get that breakout above the late March high, and we're already above the early February high. So on a relative basis, you can see the NASDAQ has been outperforming since that February high, which I think is really important. Let's move on to the chart of the day. Like I said, we got a lot to go through here. Still got a lot to cover. If you like the chart of the day, you should go over to earningsbeats.com. That's both plural, earningsbeats.com. Scroll down. We have an area where you can sign up for our free Earnings Beats Digest newsletter. It comes out 3 times a week. All it takes is a name, email address, hit that subscribe button. We like to focus on a lot of things earnings related, relative strength related, price volume, candlesticks, trend lines, all that stuff. But if you want a newsletter I like to think of it as an educational newsletter. So I think it'll help in your trading, help you learn a little bit more about technical analysis. If you like all that, make sure you subscribe. There are obviously going to be trading candidates from time to time. That's completely up to you at your risk. But individual stocks are featured on there quite often. All right, let's move on and look at the chart of the day. I wanted to point out Intel, because Intel, to me, after going sideways for a while, you can see that AD line was starting to perk up, even though prices had not broken out. And then we got the big breakout before earnings with increasing volume. I even wrote an article a while back, is Intel a new leader in the market? Are we starting to see rotation back to Intel? And I'll tell you, since the beginning of April, this doesn't look very good to me. I mean, we went all the way back down, lost the 20-day, which is unusual. Usually when you're first breaking out, your first test of the 20-day, you hold and you bounce off of it. Here we gapped below it and struggled. Went all the way down to the 50. Rebounded, we gapped above it with earnings, and then fell right back down again. And here we are below the 20-day, 2 filled candles in a row. Look at the AD line, which was looking so promising a month ago. I mean, look at where we are in price now versus where we were back here in late February, early March. Clearly, prices are way up. But look at the AD line. We've now broken down. So is this just an opportunity to get some big money out of Intel? You get a breakout. That's when you get a lot of traders jumping in. Was that simply an opportunity for institutions to jump out while retail traders were jumping in? Same thing the last 2 days. I don't know, but I just don't like the way Intel is trading here. So I would be watching 28.5 to the downside. A big move and close above 33, 33.25 is what you want to look for from a bullish perspective. All right, moving on, sector strength. So I wanted to talk a little bit about sectors. There have been a lot of things written recently about how, money's been rotating into defense and how that's poor for the market. Well, I mean, it's in the short term. For the most part, the stock market's been going sideways. We've not been getting the breakout. If you look at the S&P 500, since the beginning of April, for the most part, we're just going sideways. It's not like we've been making this big move to the upside. The big move was made back in the last 2 weeks of March, 2.5 weeks of March. Since the beginning of April, it's been mostly sideways on the S&P 500. And if you look back to the highs of where we were in February and where we are today, let's check to see where the sectors are. We have equal highs on the S&P since the early part of February. What are the sectors doing? Well, look at technology. Here it was at February. Here it is now. Money, even though we have equal highs on the S&P since the beginning of February, money has rotated into technology. Consumer discretionary. Well, depending on where you are in here, depends on how much we've dropped, but we have seen a drop in consumer discretionary. I don't have time to get into it today, but one thing I am doing is I'm doing a user-defined index showing the XLY versus the XLP on an intraday basis, ignoring gaps, because that's where you can get manipulation is on the gaps. Intraday action, the XLY versus the XLP has been going flat over the last month, maybe little, I don't know, maybe 3 weeks to a month. This has been dropping, but this includes gaps. So what I'm seeing on this chart is a little bit different than what I'm seeing using my own user-defined index, which looks at what's going on during the trading day. Much the way the AD line works, the accumulation distribution line, that ignores gaps. That's been a tremendous indicator for me since the pandemic began, because there was so much manipulation, so many gap downs with buying throughout the day. The AD line became, in my opinion, the best secondary indicator out there. And I really like the PPO, so I'm going to keep the PPO number 1 as a secondary indicator, but I'm going to put that AD line right underneath of it. I think that's an important indicator to watch. Anyway, I don't think this is as bad as this looks. I think that this is much more manipulated than you might believe, but I'll leave it at that. The other major group, communication services, look where it was in February. Look where it is now. So S&P equal, but clearly both technology and communication services are seeing money rotate in. So it's hard for me to sit back and say, well, defense is leading. Now, in the short term, yes, I would agree. Let's look at it, consumer staples. So here you can see consumer staples since February has done better, but look at the massive hit it took in January. So it's nowhere near its recent high. So short term, yes, I definitely would say that this moving up is not particularly bullish, especially when the S&P is trying to break out. But we've got some aggressive groups that are offsetting that. So I'm not really buying into the theory that defensive groups are going to take, the relative strength is suggesting that we're topping. Not yet, not based on what I'm seeing. Here's healthcare. Healthcare is about flat with where we were beginning of February. Consumer staples we talked about. Real estate. Real estate's taken a huge dive. So if you're looking for this defensive group to be moving higher, it just hasn't happened. Utilities, up a little bit from where we are right now versus where we were February 1st. We're probably up slightly. But I'm not seeing the rotation like we saw in December of 2021. I'm definitely not seeing anything like that. And so, yeah, I mean, it's something worth watching, especially the XLP. But if we get a breakout in the market, I think that changes. We'll find out. If we get a breakout and all the defensive groups lead, then that check mark will clearly go in the bears column. But let's see what happens if the S&P 500 does make a breakout. All right, chart breakouts. What I wanted to do here is just show you one easy way. If you're on your dashboard and you scroll down to your scans, if you don't see it anywhere, then chances are if you go over here to this gear shift, you haven't checked off scans and alerts. Make sure that's checked off. But if you've checked that off, when you scroll down, you should see an area that says your scans. Right here under this more drop down, go to predefined scans. New 52-week highs. So if I pull this up, there are 107 yesterday. There were 107 new 52-week highs on the New York Stock Exchange. So if I pull those up, what I like to do is then sort it by scooter order. Now, if you're breaking out to a new all-time high or new 52-week high, and your scooter's already well up into the 90s, chances are the stock has been going up and just continuing to go up. It's probably overbought. So if we pull up Hims and Hers Health, well, this one isn't too bad. It's in a little bit of a cup maybe, but you can see it's been pretty steady over the last 7 weeks, moving higher. So you've got to be somewhat cautious that these breakouts with high scooters are going to be maybe a little bit overbought, maybe a lot overbought. But one thing you can do is go down and look for breakouts where the scooter is much lower. And sometimes I'll look at the scooter and then I'll look at like areas, like restaurants. I know restaurants have been pretty strong. McDonald's just, hit a 52-week high yesterday with a scooter at 75. If we pull that one up, well, that one actually has been straight up, so it certainly isn't going to work every time. But I think some of these, if you're into the defense group, here's consumer staple, General Mills. General Mills, well, we were at 86 back in December, went down for a while, sideways consolidated here, and just recently made breakout. So maybe that would kind of fit, because it's not crazy overbought. Let's see if there's something else in here. I was looking for maybe technology. Motorola Solutions, 81. See what MSI looks like. Okay, here's one, went sideways for a while, stepped up in March, and for the most part, it's just been going sideways. Hasn't really done a lot to the upside. AD line looks good. I don't know, maybe 20-day test is something that would be appealing. But when you look at chart breakouts, they're not all the same. That's my point here. That you've got some stocks that break out, but are already extremely overbought. And those are hard. You can put them on a watch list and wait for a pullback. But I would rather get something that's been sideways consolidating. Sometimes, and I don't have time to go through the whole list, but sometimes you'll get charts that maybe have been consolidating, like MSI was for a 3-4 month period, and then break out. And usually that type of breakout, you can see we added quite a bit to it over the next couple of weeks because we weren't overbought when we broke out. So that's just another way to look for some chart breakouts. All right, earnings spotlight. I wanted to go over some of these that reported last night or this morning. SYK, this is Stryker. This is big in the medical equipment group. Down $12. This has been a great stock. I'm thinking if it gets down to around 280, 285, that could be an area where we turn around. They did beat on the bottom line, $2.14 versus $2. And by the way, everyone that's looking for really poor earnings this quarter, I don't know if you've been watching everything last night and this morning that I looked at, and I just went through real quickly this morning, but I probably picked up 20 stocks. One stock missed earnings. The other 19 or whatever all beat, including VRTX, which I'll show you here. Vertex Pharmaceuticals down $4, but they came in at $3.05 on their earnings. Expected $2.95. Arista Networks, ANET, down 8%. They beat $1.43 versus $1.35. $1.47 puts them down here near this breakout level. It's going to be an interesting move to see what happens after the open today, because it is now below the 50-day moving average. Will it rebound? We'll see. NXPI, semiconductor. They beat $3.19 versus $3.02, up $12 after hours there. That one's looking pretty good. HOLX, this is one of our portfolio stocks. They had a pretty nice beat, 106 versus 88. Stock is flat this morning after breaking out yesterday. LSCC, this is another semiconductor, another one of our portfolio stocks. Some of these small to mid-size semiconductors had not done well during the last pullback in semis, but they're starting to regain some strength. LSCC appears to be one of those, up $2.50 today, back up to, or this morning anyway, back up over $84. They beat 51 cents versus 50. Stocks out this morning with earnings. Pfizer, easy beat, 123 versus $1. Stocks up 1%. ETN, this is a portfolio stock of ours. It's in our income portfolio. Stock up about 0.75% after reporting better than expected earnings, $1.88 versus $1.78. Uber reported this morning. They beat lost 8 cents versus the estimate of losing 10 cents. Stock up 9% after hours or going into this morning. TRI, this is Thomson Reuters. This is another one of our portfolio stocks. This one's down 1.6%. They beat 82 cents versus 78 cents. And I'm going to leave it at that for earnings. Let's jump into the three you must see and let's wrap the show up. First, NCLH. This is Norwegian Cruise Lines. The stock finally got back through its 50-day moving average, which obviously was a pretty big deal. Looking at the chart, there was your breakout. Took out the prior high. Stock looks much better now with that big volume breakout. We want to hold the 20-day and even the 50-day now on any pullback moving lower. Next up, on semiconductor, they reported yesterday. Big move back up through the moving averages, both moving averages. That AD line took off again. Nice volume. Can we hold gap support down at 74.89? That's where we open. That's the level to watch. NVIDIA, last stock I have for you. This is breakout above 280 after sideways consolidation. Remember, this is the one that got up to 280, but that was going into option expiration week. A lot of in-the-money calls. Stock pulls back. Yeah, no big deal, right? Just $20 and now breaking out again, so no big deal. Well, except it helped market makers save millions of dollars when it pulled back. Looking at the chart, you don't think anything about it. Got to be aware of Max Payne. I said at the time, I would not buy NVIDIA when it was at 279, but after the drop, I said, great stock to be in for the long haul. Now you see why. Now we're breaking out. No options related pressure there. Anyhow, that's it for me. I appreciate you tuning in. Have a great day. Remember, the Fed is back with their next meeting, started today. Tomorrow, 2 p.m. will be the announcement. Later this week, tomorrow, Wednesday, ADP employment report, Friday, non-farm payrolls. Have a good week, everybody. Happy trading.